Hello learners, we again begin with a new topic. All of you might have heard about dot-com bubble, subprime crisis, stock market scam and all that. Today I am there with you to discuss about subprime crisis. What subprime crisis was, what is the meaning of subprime lending and how a remedy can be planned for that or a forewarning system can be planned for that. If you remember, there was a heavy crash in every kind of financial market as well as property market in 2008 and 9. So, that particular crisis not only affected India, but across the globe also. Or I will say origin of that crisis was out of India, but it affected India also badly. When I say India also badly, Indian stock market, mutual fund industries, bond market, banks and the Indian economy, all were affected badly. This one particular crisis made the people awake that yes, markets are interlinked. Although everyone was knowing markets are interlinked. When I say markets are interlinked, it means we have different markets: equity market, bonds market, property market, gold market. On the face of it, all these markets seem to be isolated. But yes, somewhere they are linked with each other. And how that linkage affected the financial markets, eroded the capital of investors. Investors had heavy losses, and you cannot imagine more than 150-year-old insurance companies became bankrupt overnight. That was the severity of that particular subprime crisis. So now what that subprime crisis was there, how it originated, and definitely one thing is sure, whether it is subprime crisis of 2008-9 or any financial market scam in India which have taken place in 1955, 1992, 2003 or anywhere else in the world. Only reason one is that the greed of the investor or greed of the operators which might lead to these kind of crises. Yes, regulatory aspects are also there. So what was the subprime crisis? Let us learn about it, discuss about it. Before giving you the glimpse of subprime crisis, let us understand the responsible factor behind the subprime crisis. It was subprime lending. When we say subprime lending, so lending you can go to a bank and take a loan. You can go to a financial institution, take a loan. That is simple lending activity. One person is borrowing the money, another person is lending the money. Now, what is subprime lending? Normally, prime lending means in which borrower's credentials are intact. When I say intact, because if you remember, whenever a bank or financial institution is lending a loan, there are 3 C's of lending the loan. What are these 3 C's? Bank will look for the collateral. That means the property or asset against which funding is being done. Like if you want to go and take a loan for housing purpose, to construct or buy a house, the house property value will be the collateral value. So, collateral asset is the number 1. Then bank will see the capacity. Bank will see the capacity. When I say capacity, capacity to repay. Are you having sufficient income to repay the loan of the bank, to pay the interest of the bank? And then the character or credit rating. That means what is your credit rating, what is your character? When I say credit rating, it means have you paid your past dues well in time with any other bank also, same bank also? What is your goodwill in the market with respect to the repayment track record, payment track record for the interest and repayment track record for the loan? All these 3 things have to be prime, that means at high standard, good one, then such lending is called as prime. However, the moment these things become poor, lending becomes subprime prime lending. So, subprime lending is the one in which either collateral value has deteriorated or capacity of the person who has taken the loan is not sufficient to repay the loan, or his credit rating has gone down. It has deteriorated. Now, when I say it has deteriorated, all the three parameters have deteriorated or declined. Either these were declined or in a poor shape when the bank or financial institution was granting the loan, or these might become poor or substandard subsequently. So, that kind of loan is called as subprime lending. So, subprime lending simply means giving a loan to a candidate or borrower whose credentials are not good. His collateral value is not sufficient, his capacity to repay is not sufficient, and his credit rating is not good. Either it is present at the time of lending, and due to an oversight or carelessness, banker has given a loan. So, that kind of lending will be subprime lending. Or this incidence of becoming poor, credentials becoming poor, takes place subsequently due to certain factors. So, that is called as subprime lending. So, that is the way you can say we define the subprime lending. Now, subprime lending was the culprit behind the subprime crisis or crisis of 2008-9, and the name was given to that crisis, subprime crisis. The basic agent or catalytic agent for that crisis was housing loan, housing bubble. If you remember, or you can do the search and find out, during that particular time period, that means somewhere in 2006, 7, 8, housing prices were rising day and night. And rising housing prices made it something difficult for the people to buy the house without the loan. So, those who were intending to buy the house, they went to the banks and financial institutions and took the housing loan. So, let us take how this particular bubble burst out. So, securitization is the another aspect. So, I will come down to the how loans became subprime. Let us say someone goes to a bank in 2007 to take a loan for house purpose. At that time, value of house is 2 crore. And I said it was housing bubble which was responsible for the subprime crisis. Now, this 2 crore valuation was too high. Real worth of the house may be around 1 crore. But yes, due to rising market trends in the housing property market, price was 2 crore. Now, if this person goes to the bank and takes a loan, and banks at that time were willing to give loan up to 80%, 90%, and certain private banks and financial institutions, that is non-banking finance companies, were giving 100% loan, bare minimum down payment. So, let us say he is granted a loan of 1.8 crore to be repaid over 10 years. Now, person is happy, he is paying the installment, and at that time people were getting good income in the IT sector also. So, I am referring to the country where much of the IT work is done, the USA. So, this bubble started from USA itself. Now, look at the fact. Loan granted is 1.8 crore, market value of the property is 2 crore. All of a sudden, housing prices started tumbling down. Income of the people also suffered. There was high retrenchment of jobs in IT sector. Now, suppose this particular borrower, he was in IT sector. It is an example, it is not a real case, but yes, to explain the things, subprime lending. Now, after some time, market price of this house has come down to 1.2 crore. 1.2 crore. And income of this person is also not there. Now, you can see, the moment we were giving the loan, at that time this loan was prime. After 6 months or 1 year, let us say in 2008-9, collateral value has come down, his capacity to repay has come down, and decline in both the things has affected his credit rating. Now, if bank goes to him and says, pay the loan installment, he says, I don't have the income. Only way out with the bank is sell the house because he is doing a default. That right is there with the bank. So what now bank is going to do? Bank goes, makes an auction of this house. The moment this house is put on auction, people know it. This is a distress sales. That means bank is bound to sell it to recover its loan. And that person is also saying, okay, sell my house. I'll go in a rented house. Now, if this house is sold out, when it is distress sold, bank barely gets 1 crore. And how much was the loan of the bank? 1.8 crore. Bank is having a straightway loss of the capital, 0.8 crore due to this subprime lending. Now, immediately this particular fact, so this is one house I told you. There are millions of houses, cases like this across the globe. In every country these were there. Now, the moment people come to know banks are suffering the loss, so this bubble burst out in housing market. Now, the moment people come to know that banks are suffering the loss, those who are the investor in the bank, either in the equity shares, fixed deposit or bonds of the banks, they were in panic. The equity shareholders who were holding the shares of this particular bank, they started selling the shares. Remind you, at that time share market was also at peak. And factor responsible for the share market peak was IPO mania. Now look at the factor. When people are selling the shares of this bank, people are making withdrawal of their FD in the bank, bank is in crisis. So those who were invested in bank, they suffered the loss, share prices tumbled down. And always remember, when this kind of bad news comes in the market, prices of the affected company, affected bank will be affected badly or negatively. At the same time, share prices of the good companies will also tumble down. So there was a bear run in the market. Market was in bear's grip and share market started down. So you can understand linkage between property market and the share market. At the same time, there was a crisis in the bonds market also. And why there was a crisis in the bonds market? Because bonds market is altogether different, you will say, from property and equity market. And generally, when there is a crisis in the equity market, bond market goes up. And when there is a crisis in the bond market, equity goes up. There is a reverse correlation. But at this point of time, that reverse correlation failed out. Why it failed out? So first thing I have told you, what is subprime lending and how this subprime lending, that means a prime lending in the housing market became subprime due to bursting of the bubble in the property market. And then subsequently, this outbreak of the bubble or bursting of the bubble in the property market affected the stock market. So there was a linkage between property market and the equity market, because maximum of the property was financed from the banks and financial institutions which were listed on the stock exchange. Now, who are the investor in the banks and financial institutions? Mutual funds, you and me, individual investors. So when a mutual fund comes to know, foreign institutional investor comes to know that bank is in crisis, they will sell the shares of bank. Now, look at the fact, immediately return on mutual fund will also decline. It means mutual fund industry also comes in crisis. So, three markets have gone in crisis: property market, banking segment, equity market, and fourth one is mutual fund industry. Then comes bonds market. Although normal connotation is that bonds have reverse correlation or inverse correlation with the equity market. But at that point of time, bonds market also faced the crisis. Why it happened? Securitization and subprime crisis. This is one term which I have explained you in the previous classes, securitization of debt. That means a housing loan company or a bank or a financial institution which has granted the loan. Similar kind of loans, when I say similar kind of loan, housing loan, car loan and something like that. So, let us say we take a housing finance company which has granted loan to 200 people of somewhere 1000 crore rupees. Now, all those loans are pooled together. So, a housing loan company or a bank is there. Their loans are pooled and assigned to an SPV. Their loans are pooled together and assigned to an SPV. So, let us say a loan pool of 1000 crore is assigned to SPV. SPV is a special purpose vehicle, an entity created especially for that purpose. Now, what is the aim of that assignment? That is, this SPV will issue the debentures in the bond market against the security of these house loans. It means money will come from the bond market to this SPV, and this SPV will give the money to this particular housing company. This SPV will give the money to this particular housing company. So, the money which was of housing company blocked into housing loans gets released by issuing the bonds. Bonds may be issued for 800 million, 900 million or 950 million. That depends upon the market scenario. So, one thing is sure, on housing loans, interest is earned by the housing company, and on these bonds, interest has to be paid by SPV, and these bonds are secured against the debenture. Now, regular feature of securitization is very good, concept is very good. They issue the debenture in the market. Who are the investors? General investors, banks, financial institutions and all that. Money collected from debenture, I have told you, goes to this particular entity. Now, whenever they are the house borrowers, now they are the borrowers who have purchased the house by borrowing the money. In future, when they pay the installment, they pay back the installment, that installment will be used, number one, to pay the interest on the bonds, to repay the bonds, because they are mortgaged backed securities, securitized debts, created securities. So, asset backed securities or mortgage backed securities. So, on the bonds, interest is paid out of the money collected from these borrowers, repayment of the bond is done, and whatever is left out, that is paid to the housing loan company. So, in this way, this cycle is very good to infuse the liquidity in the market, and liquidity is coming in across all the market, housing market, banking sector, bond market, and who are the investor in the bond market? You, me and mutual funds. So, mutual fund industry also flourishes. So, if this liquidity cycle continues successfully, then there is no problem, all the markets are happy. But all of a sudden, due to busting of the bubble in the housing market, there was a crisis in this particular housing market. When I say housing market, these borrowers were not having sufficient money to repay the loan. Their loan became subprime. And the moment they stop paying the money, number one, bond market will crash. Because these bonds were safe against the installments likely to come from these borrowers. So, if these borrowers do not pay the installment, then definitely interest cannot be paid on the bonds. Repayment of the bond cannot be done. And who are the investors in bonds? Investment bankers, you, me, general investors, mutual funds, other banks. So, in that way, all that is getting affected. And when they get affected, equity market will get affected, mutual fund will get affected. The bank who has given the loan, they will get affected. So, this is the way securitization affected the bond market also, and that is how we say securitization and subprime crisis. So, on one hand, subprime lending was responsible, on the another hand, securitization was responsible. So, both of these put together created havoc in all the markets tumbled down. Then comes, I already told you, IPO mania. People were mad in applying for IPO. That means, you see any IPO, people make it 100 times oversubscribed, 200 times oversubscribed without knowing what that company is doing. Now, that mad rush will definitely create a problem at the end, because at that point of time, I will tell you, there were many fake companies. They came out with the IPO, they took the money of the investor and ran away. And there are the many companies, because at that time I said .com bubble was there, because IT was booming. So, there were n number of companies, their name reflected XYZ IT solutions, but practically that company was not IT company. The company never existed. They took the money, promoters took the money and they ran away. So, initially IPO looked good, but subsequently there was no value in that IPO. So, that was responsible for that particular securitization and subprime crisis. Then let us understand what was the anatomy of this particular 2007-8 subprime crisis. The first alarm bell in 2006, HSBC Bank rang the first alarm bell about the warning of the subprime crisis. That means Hong Kong and Shanghai Banking Corporation gave a warning signal that yes, something fishy is going in the market and this bubble might burst and collapse, not one particular market, all the markets across the globe. Then the first victim, who was the first victim? The major British bank, Northern Rock Bank was the first victim of that. Mounting subprime loan accounts in USA, I told you earlier. Then the major player became prey to the crisis. When I say prey, they become bankrupt, insolvent, जिसको बोलते हैं दिवालिया हो गए थे overnight. Who were these ones? Bear Stearns, the biggest investment banker of the USA, became bankrupt overnight. The first victim in the US due to mounting losses of the mortgage lending, because Bear Stearns was in mortgage lending and their maximum of the loans became subprime. So, they had to suffer the loss. So, they were directly affected by it and it was acquired by JP Morgan Chase. So, when a bank or any institution becomes bankrupt, other one might buy it, but they will buy it at a very low price, at a cheap price. So, JP Morgan Chase bought it with the assistance of US government. And then look at the fact. US government's bailout package was there. The US government provided a bailout package of $700 billion to give some relief to all that market, those who had suffered the loss. But even they could not spread it. Acute phase came, beginning with the bankruptcy of Lehman Brothers. You might have heard about Lehman Brothers, one of the biggest investment banker in the world. In September 2008, the financial crisis entered an acute phase marked by the failure of prominent American and European banks and efforts by American and European governments to rescue distressed financial institutions. So, Lehman Brothers became bankrupt. Now, why it became bankrupt? Where the problem was there? There was another insurance company, Fannie Mae and Freddie Mac. Now, generally what we say, leverage ratio. Leverage ratio, what is the normal standard I explained to you earlier? 2:1. That means if you have $1 of equity, $2 up till $2 of loan is sufficient. But Fannie Mae and Freddie Mac, which were the insurance companies of USA, their debt equity ratio was 65:1. Now think of a scenario. A company is there in which owner's money is $1 and borrowed money is $65. It means this company is on a ventilator. Who is interested for the survival of the company? Money lenders, those who have given a loan to this company. Owner says, "Murko mar jane do. I am ready to die because I have nothing to lose." If this company is declared bankrupt, he is losing $1. Whereas those who have given the loan to this particular company, they are losing $65. So, for every $1 of owner's money, there was a loan of $65. And that too, it happened in USA, which is considered as the country with the strict regulation. Now, think of a scenario. If Indian banks are invested in this company, this insurance company, general investors are invested and this company collapses overnight. Fannie Mae and Freddie Mac went away overnight. Lehman Brothers went away overnight. Then definitely those who had invested in that, they will suffer the losses. And that practically happened. This $700 billion bailout could not do anything. So this was the repercussion or aftermath of the subprime crisis which took place, starting from the housing bubble, spreading across all the markets. Then there may be many reasons we have been discussing so far also. What are the reasons? Excessive leverage. Leverage means borrowing the money and financing your business activities. Borrowing the money, financing your housing needs. That is called as leverage. Now, if suppose you take a loan from a bank beyond your capacity is that you can survive a loan of $2 and bank gives you a loan of $10, then from where you will repay $10? Ultimately, to repay the $10 loan, you have to sell your property, and when you sell the property, property prices tumble down. It means everywhere the problem will be there. So, excessive leverage was the one reason. Then bad lending policy, subprime lending. If you see, there are the certain finance companies, they say if your credit rating is not good, come to me, I will give you a loan without much of the formalities. At that time, there used to be a concept in the market. New banks and new financial institutions came. They were saying, we will grant you loan in one day. Now, think of a scenario where in normal course of business, a bank takes 15 to 20 days or 1 month to grant a housing loan. Because what is the procedure? If you make an application to a bank to get a housing loan, they will do the survey of the property against which you are going to take the loan. Is that property really existent or not? Number one. What is the market value of that property? What is the legal aspect of that property? But bad lending means you go to a financial company, they say normal rate of interest is 8%. It is a hypothetical example. And if you want a quick loan within one day, they say we will give you a loan at 13%. Make the application today, tomorrow we will give the loan. And since you know that yes, something is not good at your end, you are ready to take that quick loan. Now, if that bank gives you a quick loan at the rate of 13%, bank is greedy at that point of time, thinking that they are earning 5% extra. But at the end, you know that the house which you are going to buy, you will never build that house. You will use the money somewhere else and run away to some other country, or you are likely to become bankrupt. You know that. And bank has not paid the attention for that. Then who is going to suffer? You are going to suffer, you know it very well. But bank is going to suffer, investor in the bank are going to suffer, depositor in the bank are going to suffer. And that was the responsible factor for bad lending. Financial engineering, securitization. Because when against the pool of housing loan, we issue the debentures. So, this house is not existing, so that bond will also not exist. Then interlinkage of market. I already told you housing market, mutual fund market, banks, all those are interlinked. If something goes somewhere in one market, it has got the ripple effect in rest of the market also. Then cognitive biases. Cognitive biases of the investors simply means in the back of the mind, investors always have a greed that yes, they are overconfident that yes, I know everything in the market. If I invest in this company will be good without knowing about facts about the company. So that is where the people were wrong. Without investigating the company's background, without investigating the company's profitability scenario, they started investing money at the high valuation. If real worth of a share is rupees 20, they were ready to buy at 50 also, 60 also, 70 also. So definitely when prices tumble down, their money will be at stake. And then role of rating agencies. Rating agencies are responsible to give rating to the borrowers. Now, if rating agency gives a good rating to a candidate who is not good one, now who is believing on that particular good rating? The money lender. Money lender thinks that if a rating agency is saying he is good one, his past track record is good, he is having good collateral value, then definitely bank is believing, but really rating agency knows he is not good. So ultimately this particular person whose fake rating has been created will not pay the loan, bank will suffer the loss, bond market will suffer the loss, mutual funds will suffer the loss, investors will suffer the loss. So these were the reasons behind global crisis. So I am not creating a fear, but yes, be aware. So we should not be fearful, but we should be aware about the things happening around us. And now, what is the rescue? Rescue is simple. Impact, I have told you, everywhere it was there. We have discussed in detail that yes, every industry got affected. So need not to deal again in detail. But yes, what is the rescue? Rescue is proper disclosure has to be there by the bank. Banks should disclose on a regular basis that how much is my lending as prime lending and subprime lending. NPA, non-performing assets. Yes, regulations are there. So if these are implemented strictly, then yes, investor can come to know where my bank is doing and what my bank is doing. Then adequate provisioning has to be there. Banks and financial institutions should maintain adequate provisioning against the expected losses likely to take place in future. And now, thank God, all the regulators after that are now strict. After 2007 to 9, those 2 years, even RBI, SEBI and SEC in USA, they have become strict with reference to the disclosure and provisioning norms. Due diligence for rating agencies. It means rating agencies should be held responsible for the rating given by them. There should be some accountability at that point of time. Then proper asset liability management has to be there at the bank, which is there nowadays in place. So you can say, I'll say yes, or you will say that particular scam affected all the industries, but we have learnt a lesson, and after learning that lesson, government and the regulators became aware that yes, there have to be some stringent rules, and now for everything there are the proper rules and proper timing is followed. And that is where I'll thank regulators that yes, they are doing well. Norms for leverage, like we say, normal standard for leverage is 2:1. So it has to be followed strictly, and that is being done nowadays also. And then capital adequacy. Financial institutions and banks must have adequate capital, so that because capital works as a cushion against the loss. If suppose you are starting your business, you always keep something in reserve for unexpected losses, so that that particular reserve can be used to absorb the losses. It is like a shock absorber. In the same way, adequacy of capital or capital adequacy simply means that banks and financial institutions must have sufficient capital which can absorb the losses if they take place. Although first of all, if we adopt these things, losses are not likely to be there, but even if losses are there, capital adequacy can work as a shock absorber. So this is the way I have discussed my viewpoint. So it is academic discussion, not blaming on anyone. Whenever you go in the market, always look for these kind of things around you before making investment, and always remember there are the interlinkages between each market. So markets are linked with each other. So be careful, be aware about that. Thank you, learners. Thanks a lot.